We are covering these 8 top actively traded stocks that are bullish today. While watching price actions, let us inform you our review on GT. Goodyear Tire and Rubber Company, known for its wide range of tires across different industries, from cars to trucks, aircraft, and even mining equipment, is having a solid day in the market. The company operates in over 20 countries and has a footprint in both retail and commercial tire services. If you've ever heard of brands like Goodyear, Cooper, or Dunlop, you're already familiar with their portfolio. Today, Goodyear stock surged by 11%, with a whopping 21 million shares traded, which is pretty impressive. This rally seems to be tied to broader market sentiment, particularly investors looking for companies that are less exposed to the risks of tariffs. With international supply chains and trade tensions often in the headlines, companies like Goodyear, which operate in a wide range of regions and have a global footprint, can sometimes be seen as safer bets when compared to more regionally focused firms that might be more vulnerable to tariff fluctuations. The 11% jump signals that investors are finding comfort in Goodyear's diversified operations. Their broad product base and global reach help shield them from the kind of volatility that might hit companies heavily reliant on specific regions or markets. Plus, with the tire industry itself seeing consistent demand across multiple sectors, this kind of stock movement isn't entirely surprising, but it does highlight investor confidence in Goodyear's ability to weather potential economic challenges. Looking ahead, Goodyear seems positioned to capitalize on this trend of reduced tariff exposure. With a strong global presence and a range of products spanning from consumer vehicles to industrial needs, the stock's recent surge may be an indication of continued investor optimism as the market looks for stability in uncertain times. This might be a good moment for those keeping an eye on the tire sector to consider Goodyear's potential, especially if broader trade tensions continue to influence market behavior. Our review on KR. Kroger Co, the well-known food and drug retailer, has built a massive presence across the U.S. with its supermarkets, pharmacies, and fuel centers. It's also made a strong push in the digital space, providing customers with a seamless omni-channel shopping experience. Whether it's through curbside pickup at over 2,350 locations or delivery via Kroger Delivery, the company is clearly meeting demand for convenience. The mix of physical stores and innovative digital solutions is a big part of why it continues to be such a staple in the market. Today, Kroger stock saw an impressive jump, up more than 5%, with over 14 million shares traded. The bump in share price comes after Guggenheim analyst John Heinbockel maintained his buy rating on the stock and even raised his price target from $71 to $73. His reasoning? He believes that Kroger's solid operational momentum, particularly with the re-entry of its ESI network and the growth of its delivery services, will help the stock maintain its positive trajectory. It's clear he's pretty bullish on the company's continued growth, especially as it continues to expand its media business, which has been a profitable part of the equation. That said, it's not all smooth sailing. There are some mixed signals from the investment community. While Guggenheim and Argus Research have kept their positive outlook, Melius Research downgraded Kroger to a sell earlier this week. On top of that, insider selling has been on the rise. For example, Kroger's SVP Gabriel Arriaga recently sold a substantial amount of stock, which could hint at some caution from within the company. All in all, Kroger's mix of strong fundamentals, expanding delivery options, and digital growth makes it a compelling play for many investors. However, with some insider sentiment pointing the other way, there's a bit of caution that comes into play. It'll be interesting to see how things shake out, but right now, investors seem to be leaning on the side of optimism, reflected in today's positive price movement. Our review on NAK, Northern Dynasty Minerals Ltd, a Canadian mineral exploration company, is focused on its big asset in southwest Alaska, the Pebble Project. This project is centered around a massive deposit with copper, gold, molybdenum, silver, and rhenium, which could potentially be a major player in the mining sector. The company's strategy revolves around the development of this massive deposit, and it owns a 100% interest in the project through its subsidiary, Pebble Limited Partnership. Today, Northern Dynasty saw a solid 15% jump in its stock price, which is definitely noteworthy. While the company's been working for years to bring the Pebble project to fruition, any significant movement in its share price like this often signals something important is happening, whether it's new investor interest, an update on the project's development, or even market sentiment shifting in its favor. Of course, this is a speculative stock, so big price movements like this can happen quickly, driven by news or just a swing in the market mood. For investors, it's all about the potential of the Pebble project and how close Northern Dynasty is to advancing it through the regulatory and development hurdles. The 15% rise in its stock today could be a positive sign of optimism, or it could be a sign that the market's starting to pay more attention as developments around the project heat up. Either way, it's a reminder that with mining stocks like this, the upside potential is often paired with significant risks, and it's a space to keep an eye on for any news that could move the needle. Our review on DG. Dollar General Corporation, a well-known discount retailer offering everything from everyday essentials to home goods, has been catching some eyes recently with an impressive 18.5% rally in March. This is especially notable considering the broader market was down. So what's behind the surge? Well, Dollar General's fiscal fourth quarter results played a big role. While earnings were hit by one-time charges related to closing underperforming stores, the company saw revenue growth of 4.5%, exceeding expectations. The same-store sales metric also surprised to the upside, with a 1.2% increase, beating the 0.93% analysts were predicting. But there's more to this story than just earnings. The rise in Dollar General stock can also be attributed to its positioning in a potential recession. The company is seen as a recession-resistant stock, offering affordable essentials that consumers, especially low-income ones, continue to buy even in tough economic times. With inflation still being a major concern, Dollar General's discount offerings make it an attractive option for budget-conscious shoppers. This shift into recession-proof territory is likely fueling investor interest, especially with the stock trading about 70% below its all-time highs. Fast forward to today, and we're seeing another 4.67% increase in Dollar General stock, as the company continues to expand its beauty and personal care offerings. It's 7 days of Savings Beauty event. That said, while Dollar General shows promise, there are still risks to consider. Its margins have been under pressure, and the company's full-year earnings guidance came in lower than analysts expected. So, while the stock offers potential for growth, especially in a recession, it's not without its challenges. If you're looking at Dollar General, it's an interesting play for the current economic climate, but it's definitely not a risk-free investment. Our review on NMAX. Newsmax Incorporated is a well-established player in the conservative media space, with its roots going back to 1998. The company runs Newsmax Media, which is known for broadcasting news and lifestyle content across television and digital platforms. Recently, Newsmax has been riding a significant wave of attention following its IPO, which took place on March 28, 2025. The stock has soared by an incredible 735%, which is largely attributed to retail investors rallying behind the stock. The company raised $75 million in the IPO, with shares priced at $10 each, and by April 1st, the stock closed at $233 per share. That's an astronomical jump, pushing Newsmax's market cap to a staggering $20.8 billion. Thomas Peterfy, a key investor, saw his 25% stake in the company balloon into a $6.2 billion windfall. Now, while all of this sounds incredibly impressive, the ride has not been smooth. In fact, Newsmax has been as volatile as a meme stock, with shares plummeting by 77% on one day, only to bounce back and increase 18% today. It's no surprise considering the type of investor backing it, largely retail investors, many of whom are supporters of former President Donald Trump. With that kind of backing, the stock has been seen as a bit of a Trump stock benefiting from his loyal base. But here's the kicker. While the stock's recent spike has turned heads, there are significant risks involved. Newsmax isn't just a conservative media company. It's also a business that relies heavily on advertising revenue, around 64% of its total $171 million in 2024 revenue. And with the looming threat of tariffs and economic slowdown, advertising budgets could get tight, which might impact the company's bottom line. Plus, it's not exactly clear what direction Newsmax will take after such a wild ride in the market. For investors, it's worth noting that this stock has become a meme-like phenomenon, and its future could be just as unpredictable. So, while Newsmax's IPO and subsequent stock spike have been impressive, it's essential to be cautious. The stock has shown it can swing wildly, and with its financial losses last year, it's clear that the company's fundamentals still face challenges. If you're considering jumping in, you're betting on an unpredictable, high-risk scenario that could continue to captivate retail investors, but might not offer the stability some are hoping for. Our review on STNE. StoneCo Ltd has been making waves in the financial tech space with its innovative cloud-based platform that helps businesses, especially small and medium-sized ones, connect with customers and grow. The company offers a wide range of services, from payments and digital banking to software solutions like point-of-sale, POS, and enterprise management tools. StoneCo's mission is to empower businesses with everything they need to run smoothly, whether it's handling payments or improving customer relationships with CRM and e-commerce tools. Today, the stock is up by 6.15%, which is definitely a noteworthy jump, especially in a market that's been a bit shaky lately. It's clear that investors are responding well to the company's direction. The mix of financial services and software has positioned StoneCo to tap into the growing demand for digital transformation among micro, small, and medium businesses, MSMBs. The company's ability to provide integrated solutions for payments, credit, and even insurance is helping it stand out in a competitive landscape. The 6.15% rise could also reflect growing confidence in the company's long-term potential, especially as MSMBs continue to look for tech-driven solutions to streamline their operations. StoneCo is well-positioned to capitalize on this trend, and as more businesses adopt its services, it's likely we'll see more consistent growth. While today's jump is a positive sign, it's always important to keep an eye on broader market conditions and the company's ability to continue expanding its client base and refining its offerings. But for now, it's a solid move for investors to take note of. Our review on LW. Weston Holdings Incorporated is one of those companies that kind of flies under the radar, but plays a huge role behind the scenes, especially if you've ever had fries at a restaurant. They're a global giant in frozen potato products, serving up everything from classic fries to sweet potato offerings to food service distributors, restaurants, and retailers all over the world. Now, today's 10% stock jump is catching attention, and for good reason. Weston just reported their Q3 results, and overall, it was a solid performance. Net sales were up 4% to about $1.52 billion, and while net income held steady at $146 million, income from operations rose 11%, and adjusted EBITDA grew 6% to $364 million. These are the kind of steady, healthy numbers that investors like to see, especially in a food industry name that isn't trying to be flashy, but just wants to keep delivering. But there's more to it. The company reaffirmed its full-year outlook, signaling confidence going into the rest of 2025, and that tends to give investors some peace of mind. Behind the scenes, they're also working with AlixPartners on a broad cost savings and value creation plan, which could help streamline operations and improve margins even more over time. On top of that, they've been returning value to shareholders, $151 million in stock buybacks and dividends last quarter alone. That said, it's not all smooth sailing. They're dealing with some real headwinds, including softer restaurant traffic, especially at burger-focused chains, and a tougher pricing environment. Their international business took a hit too, mostly from pricing pressures and competition. Costs are up due to higher inventory and logistics, which trimmed some of the margin expansion they might have seen otherwise. Still, Lamb Weston is showing it can adapt. They've launched new products, like fridge-friendly fries and battered onion rings, and their innovation pipeline seems to be resonating with customers. So that 10% pop in the stock? It's really about the market recognizing that, even with some challenges, Lamb Weston is delivering where it matters: steady growth, strong execution, and a clear plan to get more efficient. For long-term investors, that kind of combo is always going to be worth paying attention to. Our review on RR. Lamb Weston Holdings Incorporated is one of those behind-the-scenes powerhouses in the food world. If you've ever ordered fries at a fast food spot or a sit-down chain, odds are good they came from Lamb Weston. The company specializes in frozen potato products, from classic fries to sweet potatoes and appetizers, supplying restaurants and retailers around the globe. They've got a solid footprint in both North America and international markets, working with everything from food service distributors to grocery chains. Now, today's nearly 5% bump in the stock is part of a continued positive reaction following their latest earnings report. Earlier this week, they posted Q3 numbers that showed steady, respectable growth. Net sales up 4%, operating income up 11%, and adjusted EBITDA climbing 6%. Not massive leaps, but in this environment, that kind of consistency hits different. It tells investors the fundamentals are intact and the business is moving in the right direction, even with a few bumps in the road. What's likely keeping the momentum going is their reaffirmed full-year outlook. That kind of confidence tends to give the market a reason to stick around. Plus, Lamb Weston is actively working on cost-cutting and efficiency plays, teaming up with AlixPartners to squeeze out more value from operations. They've also been rewarding shareholders directly. $151 million returned through buybacks and dividends last quarter. Still, there are challenges. Restaurant traffic has been a bit soft, especially for burger chains, which hits a core part of their business. Pricing's also been tricky, and international operations are feeling the heat from competitive pressure and less favorable mix. But even with those headwinds, the company is keeping its footing. Between the product innovation, like fridge-friendly fries and cheesy bites, and a strong liquidity position, they're positioned to stay resilient. So this 4.76% move today feels like the market continuing to nod its head, saying, yep, they're on track. Not flashy, but steady, and that can be just as powerful. Please subscribe, give the video a like, and watch more from our playlist. Thanks.